Welcome to the Invested Teacher Podcast with Kyle Pierce, Matt Bigley, and John Orr.
Get ready to be taught as we share our successes and failures encountered during our real-life lessons, learning how to build generational wealth from the ground up.
Welcome, Invested students, to another episode of the Invested Teacher Podcast. And this episode is going to be an interesting one. This is something that we have debated a lot ourselves, and people constantly ask, when comparing returns in real estate to perhaps the most common asset class for investing, that is the stock market, which one wins? And this question came up because of an article I was reading in the Globe and Mail. And, I try not to consume a ton of news, but when I do, I go to what I think of as a really good source, the Globe. So that's part of my, morning routine to scroll through. And there's a personal finance columnist in there named Rob Carrick, who is constantly commentating and writing articles on things that are really interesting. He's asking questions. He's, taking things readers are asking about and doing some analysis. So this article, and we're going to share the link to this, was titled "The Stock Market versus Housing: A 10-Year Look." So we're going to jump into the premise of this article today and do a deeper dive into our take on this big question and this exciting question, and talk about it not only from the perspective that Rob Carrick looked at it, but from a real estate investor's perspective as well. So really excited to dive into the numbers and to help answer this question, because I think this is one that really got my curiosity piqued. And I think when I flipped this over to you guys, we had a lot of good dialogue on this as well.
Yeah, absolutely. Matt, when you're always great at sharing the great articles in the Globe and Mail. I am not much of a reader when it comes to the news or any of those things. I do click on links in social media. So really, it's like if it hits my feed, I might find it. And if not, I'm not going to see it. So it's great that we have Matt, who, I think that history teacher in you is there, right? Like reading up on the articles and what's going on in the world. I think it's awesome. So when you shared this one though, Matt, it was interesting because right away I wanted to, being the math teacher I am, I wanted to make a prediction in my mind. And I was like, which one is going to win? Because we've been in this massive bull market in all markets, right? And really that's been going on for quite some time. And now that we see inflation kind of getting out of control, and I know that now with rates up, the Fed is trying to get those inflation rates under control. But ultimately, as inflation rises, asset prices rise as well, and that factors in. And then, of course, as they rise, people spend more money. So we get into this crazy cycle. But over the past 10 years, things have been nothing but green. You know what I mean? The financial crisis back in 2008 and 9 is sort of when, we saw the last sort of big halt in the markets, the reset, we'll call it. And then all of a sudden it's just been go, 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 even though we've had these little blips along the way. So right away, my thought was, I've seen most recently, we've seen real estate prices sort of spiraling out of control in many markets, the US and in Canada, and even here locally in our smaller, small town market of Windsor, Essex County. And ultimately I was it's going to be a close call, but I did personally put my money in the stock market simply because it was it just seems like it just kept on going regardless. But this really caught my attention. John, what were you thinking as soon as you saw this headline before you clicked on the link that Matt shared the other day?
Good question here. So stock market versus the housing. I was imagining, because it was going to be close in my initial estimates, because like you just said, Kyle, both have been kind of roaring along. And then my wonder, and my immediate wonder was, the stock market as of, late 2022, or start of 2022 has kind of been tumbling a little bit to kind of self-correct, doing a little bit of some correction here. So my wonder was maybe the house prices haven't come down as much as the stock market. And if we look at that time frame, it's quite possible that the housing market has done a little bit better than the stock market. But generally, my intuition also kind of kicked in to say, hey, isn't the stock market always going to do better? Isn't that why it's so Isn't that why everyone does that? That was like what was running through my mind is like, doesn't it have to be the better option? Otherwise, why are so many people putting their money over in the stock market? So when we kind of dove into the article, it basically, if you kind of break down where some of the data came from, and what they looked at from the data from 2012 to 2022. We're not done 2023 yet, and looked at what the stock market did over the course of those 10 years. And then, thinking of the annualized rate of return over the course of those 10 years. So if I just kind of pull some numbers here, folks, when I look at I think in this one, use the TSX, the composite index, they had a gain of 7.7% for those 10 years. And then if you looked at, say, just a low-cost exchange-traded fund, which was 7.69. So about, 7.6, 7.7 every year you're gaining on your investment if you had, say, invested some money back in 2012 versus today. It sounds pretty good. So the question, guys, is like, did the housing market beat that, or did it not beat that?
I think at first blush, when I first read this article, I knew it would be such a good one for you guys because of your number sense and your love of numbers, and you were just going to take this into, the world's greatest rabbit hole of really number crunching this. I was actually surprised that the numbers weren't higher, and I guess it's only because I haven't done this research, hadn't done this number crunching. I thought, God, with some of the rates of return that we've seen in our own personal real estate portfolio, it's been pretty wild. And I just assumed the stock market, because it is the primary place where people tend to do their investing.
Mm-hmm.
I actually anticipated better returns. So at first blush, I said, geez, can these numbers be right? Obviously they are. But I thought, how does this impact us as real estate investors, maybe versus owning our own homes, and what would that mean for other investors? So I'm really excited to hear how your math minds worked when you started to dive into these numbers, and where you've taken this conversation. I think it's our subsequent discussion has been really, really fascinating.
Yeah, for sure. And it's interesting because, Matt, I know, like, when you read it, you flipped it to us. We sort of came in with these like wonders, and just like you, I was sort of like, I guess I was a little bit like, sort of like, only like 7.7%. And you obviously have this recency bias as well, right? Like these last couple of years, like stock market, housing, everything's kind of blown up. So you just sort of assume it was that awesome for the last 10 years. And the reality is it wasn't. Now, something for us to note is that if we, that was the stock market here in Canada. So we're looking at like, the TSX and, Canadian markets. The S&P was higher at around 15%. And that article does cite that. So I was like, okay, so that seems like a little bit better. But then when we looked at the actual housing returns, it was actually somewhere around 6.8%. And I think like you, Matt, like I was sort of like, I'm like, okay, like I see it's close, almost the same in the Canadian markets, but it's like, wow, it's like you would have did way better if you put it into the S&P in the US. Now, a lot of Canadian listeners, they may or may not realize this, but if they are just sort of giving their money to their banker or whatever, their banker probably has them in different funds based on their risk. We've talked about this before, but oftentimes like Canadian banks have a lot of funds that are very Canadian weighted, right? And there's some tax benefits to doing so, but I mean, on the return side, not necessarily all that great if you can almost, more than double your return in the S&P. Now, we don't know if that's going to repeat over the next 10 years. Like it could, it could flip flop. But ultimately, Warren Buffett always says, like, never bet against the U.S., right? So I would argue, having money over there is not a bad idea. And then I sort of, started thinking to myself, like, what is going on here? Because we're all like very, I would say pretty keen investors, both in the stock market, right? So we understand the stock market, we understand options trading and those sorts of things. I've even done some technical analysis along the way. But we also, feel more connected and more, I guess, have more trust in the real estate market. We're like, what the heck is going on here. And I had to reread the actual article and sort of like dig in and go like, what are we actually comparing here? And John, you looked at the article and you actually saw a comment that jumped out at you. What did that comment say? And then sort of what rabbit hole did it send us down to kind of maybe look at this from a more deeper or a different lens anyway?
Yeah, so I jumped into the comments, and one of the comments was specifically, I think it's one of the first comments, and it basically said like when you're looking at the rate of return, somebody said, that also. If you're going to go down the housing route and think about housing, well, that also involves operational costs and heating and taxes and repairs and upgrades. And I was like, wait, this gave me a little bit of pause. I think it gave you guys pause too. That what's happening, I think, in the data, and this is where we started to question, like, what is the 6.8%? Like, where is that coming from? Like, how? Like, so that they have some quoted numbers in their article, and they're basically saying that if they looked at national resale prices in homes from 2012 to 2022, the average resale of a home was $363,779 in 2012, and then in 2022, that average home resale value was $703,875. So if you think about that 10-year difference, and you think about compounding interest, and if you took 363,000 and it grew at a rate every year, building up to 703, that's where the 6.8% comes from. So then our immediate idea or immediate thought was, wait, that's just the appreciation on the value of that home.
Bingo.
And okay, so they've only considered that if I was only comparing the stock market to appreciation of my current principal residence, then, and I only wanted to look at those two, then yeah, I've got to take in my housing costs, all these other things that aren't included in that appreciation. Like, my house isn't an asset class to compare to the stock market. The stock market's going to beat it because of those things. Like, we can't think of our principal residence as that primary asset that I think a lot of people do think about. So that immediately started to think about our question for us. But like, of course, the stock market is beating that asset. But the way we've been talking here on our podcast is that there are 3 silver bullets to real estate investing, and especially if you're going to be, thinking about real estate renting and being a real estate investor. And that's where our head automatically went. Be like, wait a minute, if we take into actually a real estate investment property where we've got our 3 silver bullets, then there's a lot more upside that we have to now factor into this comparison.
Of course.
One of the important questions or what realizations for people to think about with this is comparing your primary residence to investing in real estate, as you've just said, John. And I think that when I talk to clients about buying their primary residence, that's oftentimes an emotional decision people are making, versus when we're buying real estate investment properties, that's very much a numbers-based decision, very logical type of decision. And so, if we look at our primary residence, and Rob talks about this in the article, the author of the article talks about this, he talks about some of the great tax advantages of selling your primary residence. Primarily, there is currently a tax exemption when you sell your primary residence. So you get to keep all the proceeds of that, which is pretty incredible. What's happened with primary residence is, over this major real estate bull run, is that people have started to think about their own houses as an investment. And, when we look at real estate as investors, and this is true for Grant Cardone, Ramit Sethi, a lot of authors that we follow out there, they're going to say that your primary residence is an expense. It is not an asset. And therefore your expectation of it is that, it beyond appreciation, it's certainly not cash flowing for you. One of the exercises I go through with home sellers a lot of times is to look at how much their primary residence has gained in value since the time that they purchased it. And we almost liken it to saying, like, you've been paid to actually live in your primary residence. And that's mind blowing for a lot of people, because again, when you live somewhere, it's because you need shelter for your family. You want a place to call home, and all of those sort of psychological and basic living needs that a primary residence fulfills, not that of being an investment asset. But again, over these last number of years, we've seen huge gains in average price points. and primary residences have indeed become an asset, even though I don't like to think about them that way.
Mm-hmm. Yeah. And maybe even like if we were to kind of split hairs a little deeper there, it's like it's an asset from the perspective that it does keep up with inflation. Like at least it doesn't depreciate, like the building does. Like your roof's going to fall apart and, eventually your foundation will need repairs. So those pieces are going to depreciate over time. But luckily your land is kind of working in the opposite direction and tends to sort of like overtake or overcome those expenses. So it's one of those things where it's like looking at it as your main investment. Like when you invest in the stock market, you're typically investing for probably a longer period of time, unless you're like a very active trader and that's sort of your job. But the reality is like your home is a thing that you put money in. We say it's an investment, right? Like, well, I'm going to invest in my primary residence. But in reality, it's like you got to enjoy that home. And you were lucky enough that it didn't lose value the day you drove it off the lot, like a car does, or, like many of the other things that we purchase in the real world that we do from like more of an enjoyment perspective than, say, an actual investment perspective. So for us, that was massive. And then, John, you were saying this, but we were just going to riff on how the article maybe just doesn't tell the whole story. And you said, well, like, why don't we actually tell the whole story here? And I thought that was an amazing idea. So what we're going to do here is we're actually going to, if you're with us on YouTube, you'll be able to see this. If you're not, another reason to head over to YouTube and subscribe to the Invested Teacher channel. I'm just sharing a screen here. Now, this isn't pretty. We kind of crafted this in 5 minutes before we hit record. But, just to kind of like highlight this 2012, you'll see I'm highlighting, the average price. And we're going to look in Windsor, Essex County, So Matt, being an amazing realtor in this area and having access to all the data is something that, he uses in the process when you're buying and selling a home with him, so that you can actually get a sense of, what your house is worth and how long it should sit on the market if you list at certain price points versus others. So Matt's pulled this data and found out that locally here in Windsor, Essex, in 2012, if you were to buy the average home, right? So again, we're not talking investment properties or primary. Most of those are going to be primary residences, right, from the data. The average price was around $170,000. Now, people in GTA or other big city centers are probably thinking like, holy smokes, that's so cheap. That's insane. That's like how much a parking spot costs in Toronto. The reality is that's what we were, able to purchase the average property in Windsor, Essex. And now in 2022, that number has more than doubled, almost like maybe even tripled. Is that fair to say? To $537,000. Still in greater city centers or bigger city centers, probably still pretty like, low from what you're thinking. So what we did is we actually looked at this locally here, and we used essentially trial and error. We were just playing with different compounding rates here each year, and we found that it's about 12.1% just in appreciation here in Windsor, Essex. So when we looked at that article, it's talking about all of Canada, right? Like, so you've got like some markets that have seen a lot of appreciation, some markets who haven't seen appreciation, and so on and so forth. So here, just in this area, we're seeing 12.1%. So we beat the TSX here. We still haven't beat the S&P 500 over the last 10 years. But this part, and we're just going to talk about like one of the silver bullets, and it's one that we actually, we haven't even called it a silver bullet. It's like the hidden silver bullet, and that's just the leverage aspect of real estate, right? Like it's something that sometimes you don't see visibly, but ultimately when you buy that property in 2012 for $170,000, most likely the vast majority of people are not buying it straight up with cash. If it's a primary residence, you may have bought it with as little as 5%, right, down. But if you're an investor like us, you probably purchased with 20% down if you were buying it individually as an investor. If you're in a corporation, like Matt and I began with our North Shore properties, we'd be putting down 30%. So we're going to look at 20% because I think the people listening to this podcast are more likely in that boat than in the corporate boat. So when we look at this and we go, wait a second, I only actually had to put down $34,000, about 20%. You can, add a little bit onto that if you want to include closing costs and any of those other pieces, land transfer tax and so forth. But we're just going to look at the down payment here for a second. And what we found is that in order to get to the difference, so over 10 years, the average house rose in value by about $365,000. That's awesome. Like, that's fantastic. That's just appreciation. That's one of the 3 silver bullets of investing in real estate. But you only put $34,000 down. So basically what that's saying is that you took $34,000 and you turned it into that difference of $366,000. So basically that profit on that property, if you were to sell it, you would walk away with $366,000 without considering realtor expenses and those pieces there.
Let's pause here for a moment here, Kyle, and explain and make sure everyone kind of captures this amazing benefit, right? Like you only put $34,000, but you have gained, what you have gained is the rights to own a property. That was worth $170,000, right? That's that leverage piece, right? Like we've gained the right to own the what happens after we buy it, and what happened after we buy it is that it appreciated in value over the course of those 10 years. And Kyle's pointed out, remember, it rose from 170 to about 537. We've got a difference there. You pointed out, Kyle, 366,000. So your actual value was your equity when you bought the home was $34,000. That's how much your share was worth if you sold the house the same year, minus any sort of extra costs that may have incurred. But what happened, right, over the course of those 10 years is, not considering anything about mortgage paydown at this point, is that now the house is worth for $537,000, and your equity is now that difference. Like that difference just got tacked on to because if you sold the house, you owe the mortgage amount, whatever that mortgage value was, and you've got this extra equity in the home, right? So that's like an amazing kind of benefit right there, and that's what we factored into thinking about, going from that first year to the 10 years down the road, your equity has built up, by a 26.5% rate of return per year. Per year, which is now beating the S&P 500.
Yeah, absolutely, John. And when I look at this, and if we actually kind of run those same numbers here, and I see Matt's looking at the screen, and he's kind of going like, "Oh, wow, like that's awesome." Like until you actually like run the numbers in this way, in this like, we'll call it super over analytical way that I tend to do things in, it's hard to fathom like what that actually means, right? We just look at absolutes, right? You look at, hey, I earned this much more money. Like I am this much more, my net worth is this much greater. Amazing. A lot of people look at it as a multiple as well. They go like, wow, I 2x, 3x, 4x. In this case, you've almost 10x'd your down payment from like $34,000 to $366,000. So you've more than 10x'd it. Now, again, we're not talking. Go, Matt.
I think we need to just like pause here, for the emphasis sake, because there are these moments, and I've talked about them in past podcasts, where like your mind is just so blown, where like the numbers as you say them, guys, almost don't start to make sense to people and sound real because of how big they get and how big these rates of return get. And in my real estate investing journey, these are the moments, again, not being a numbers guy, not having a math background. I love how you guys can unpack this to really truly think and comprehend that you've just turned $34,000 into $358,000 if it's your primary residence, completely tax-free. And if we go back to those values of $170,000 10 years ago to $537,000 now, you've done that leveraging using the bank's money. Like, this is crazy. This is mind-blowing. And this, ladies and gentlemen, is the true magic of real estate investing. And as we've spoken about earlier, this is just one of the ways to make money in real estate investing. Like, my mind is blown again, and I'm already a true believer in this stuff. Where do
Totally,
I
Matt.
sign up?
I love it when you said like it's, you know, it's magic, right? And it's like, and it's only part of the puzzle, right? Like it's only part of the whole picture. So, you know, we talked about this like 10xing idea, right? Like if we look at it from a compound interest perspective, your down payment went up on average of 26.5% compounded annually over those 10 years. But, you know, John, I want you to be like the listener right now. And I want you to like, what questions, because like I'm excited, Matt's excited, but John, you always have like a better perspective on sort of like, what are people thinking right now? Because like, we certainly don't want people to just jump in, you know, without thinking into some random real estate deal.
Yeah, you're pointing out my devil's advocate like mind that just always automatically goes to the opposite point of view, you know, like so this kind of goes back to that comment, right? Like if we're only thinking about our principal residence here, and this is why I made that comment earlier, that the principal residence is not an asset. And it's like I'm having a hard time comparing these two, and this is natural. Everyone who's listening right now and thinking about like my home did go up in value, but you know, over that time I paid interest payments to the bank, you know, to my mortgage lender this whole time. That was a lot. You know, there's a lot of your principal is not, you know, gets paid down. So there's like things like that are coming out of your pocketbook, and you're like, okay, well, should I factor that in? And then there's like, okay, what about all those other expenses that go into my home? Should I factor that in? Like, shouldn't I factor in all the costs that I had to pay to be eligible to get that gain of that appreciation? And because somebody might think, well, if I went the stock market route, I have very minimal costs when I think about, you know, if I have a brokerage account and I put some money over there and I let it sit for that whole time, there's not a lot of fees that I'm going to be paying over that course of that time. And actually the stock market numbers we pulled consider all of those kind of dividends already added in, you know, like not being a cost, but an added benefit. But, you know, there's not a lot of costs to kind of think about on the stock market side, but a lot of costs on the real estate side if I'm just thinking about my principal residence. So what do we think, guys? Like, should the 26.5%, you know, be a real number that we consider here as an annual interest, you know, an annual rate of return for this scenario?
Yeah, John, I mean, such a great question for people. And let's go back to this point we made earlier. Like, our primary residences, yes, of course, there's interest to pay on your mortgage. There's roofs to replace, you know, there's capital costs. There's improvements to make. You know, the wife wants a new countertop in the bathroom. Like, there's things that you're going to do over time. But this is your primary residence. This is the place where you live. This is the place where you raise your family. And this is not supposed to be viewed as an investment. And again, the last 10 years with these crazy rates of appreciation, it certainly has become an investment. Like, think about this. You know, say you moved into your house 10 years ago and paid that $170,000, and your neighbor, maybe with a similar home, moved, and a new family just moved in, and they paid that $570,000 plus. Isn't that kind of mind blowing to think that you're into your homes for such different numbers? But again, your primary residence, we don't want to think about it as an investment. We don't want you to buy a primary residence because you think it's a good investment, and we don't want you to live in your house like it's an investment. And this is, I think, a really apt time to pivot to how we really can quantify our rates of return by looking at investment properties in real estate. Because when we analyze an investment property, we analyze all of these costs and all of these numbers, and we really track them, unlike with a primary residence, in which we accept those sunk costs of having lived somewhere or living somewhere. So let's now look at real estate investing and the 3 silver bullets, 4 if we count leverage, and how we embed the costs and understand the rates of return given all of those things.
I love it. It's like the way you just summarized that is almost like the appreciation you get on that primary residence, like a bonus. It's like you lucked out, you know, like you lucked out that, hey, everything went up. But here's the crazy part. If you plan on living in your primary residence for the rest of your life, it like kind of doesn't matter. Like it's going to be maybe helpful to the next generation, right? If you were to leave your property to someone. But the reality is like if you like your home and you just want to live there and that's why you bought it in the first place, this is kind of like almost in a way like a silly comparison. So the answer someone might have is like, well, wait a second. Let's say I had $100,000 in the stock market. I guess the question they might be wondering is like, should I leave it in the stock market or should I put it on my mortgage because my property is going to appreciate? And I would argue not if you're looking at it from a return perspective. If you're looking at it to get rid of your mortgage and it makes you sleep better at night, then maybe fine, but not from an investment sake. But like Matt's saying is like, would I potentially take, this is not a recommendation, but would I personally take $100,000 to use that as a down payment in real estate for an investment property? Because like Matt's saying, we're going to consider all of these factors. Yes, absolutely. As long as the numbers make sense, right? And for us, if we go back to this example, this $34,000 down payment, we would have only entered into that particular deal or that transaction if we knew that there was a rent. And we usually we don't look at top end rents. I think we've talked about this before. We try to find like an average rent. And then a lot of times we even bump it down a bit because we're like, well, like what if the market changes, like what if the major, here we're at Automotive City, like what if Ford, cancels a shift and then all of a sudden people are leaving the area. We want to know that those rents at a lower end are going to be able to at least support it. Might not cash flow at these lower numbers, right? But we can feel good that, hey, is the mortgage going to get paid? Which, John, you had articulated, like mortgage, your principal pay down gets included in there. One of the silver bullets gets taken care of. And is there enough of a buffer there to cover your typical expenses? Property tax, insurance, utilities, if you're paying the utilities, but then also vacancy rate and a capital expenditure rate. So that number that you feel is going to put you in a situation where you're not going to lose your shirt. Because here's the crazy part, is that these last 10 years were amazing. But remember, in earlier episodes, we have never gotten anywhere close to using an appreciation rate of 12.1% if we look at the local market, or 7.69% if we look at the S&P or the TSX. We usually use 3% as our appreciation rate. Now, is every year guaranteed to be 3%? No, but that's a number that we feel comfortable with. And over the long term, as long as imagine if you had a year where real estate prices dipped, and they did dip over the last year, where it dips and the value of your property dipped the very next year after you purchased a property. At the end of the day, as long as you are able to support that mortgage and continue floating along, that property will, over term, historically, right, over 100 years here in North America, we know that that property is going to come back. And as long as we're not already losing our shirt to try to support that mortgage or those expenditures, then this is going to be a massive win. Will it be 26.5% on your down payment win every year? We can't guarantee you that. We definitely can't. But what we can guarantee you is that, hey, you're going to be in a pretty good place because everybody needs a spot to live. We know that there's a housing shortage that has not changed, despite the fact that we are now considered, some would say we're in a recession already here in North America, in the US and Canada. The reality is property is still going to be scarce. And as long as that property is able to produce income to support the continued ownership of that property. I loved how John said, it's like to maintain control, to have control, the optionality on that particular asset, then you're going to be like winning in the long run.
That's a great kind of summary. And so what I'm hearing is thinking about what we were talking about on this kind of the appreciation being one of the bonuses. Remember that when we enter in a real estate investment deal, Kyle's articulated the other silver bullets on thinking about mortgage pay down. So think about that. Even if in this scenario, if we had purchased that property, that average property as a rental, then all of those expenses are included. We are getting that bonus was that getting that 26.5% per year return because of the way that the property appreciated, considering that we budgeted for 3%. And then that's not including the mortgage pay down that happened every year because the renter was paying down that mortgage. So that other kind of silver bullet is an amazing silver bullet to kind of add on. Like we're clearly beating what the article is suggesting that like if you just look at the numbers, that article was saying that the stock market was the better choice because if you went with U.S. stocks, you were getting a 15% return. But if you think about all the silver bullets and the real estate investing, in real estate investing with thinking about your rate of return, it is so much better to go the housing market.
Can I just add two more things as well? And this is, and then we're going to wrap up and we'll flip it to Matt for your big takeaways and we'll go around the room here. But, and I'll start with mine. Like, I hope a takeaway for people who are listening is, we did talk and reference the different silver bullets, but the reality is that 26.5% was just on the down payment. And the reality is we did not factor in principal pay down. We did not factor in the potential for cash flow. Of course, nowadays, and we're going to have a future episode on this, cash flow is becoming a problem in a lot of places, like even locally. It's very difficult for us to get a cash flowing property. Our most recent deal, we've talked about it, our 9-plex set that we have with one of our joint venture friends here. That property does cash flow, but it's not like massive. Like, it's not like we're able to like change our lifestyle off of the cash flow. It's just a nice to have in case there is some sort of other expense. So we're going to have a future episode to address that particular challenge and what you might consider doing. But ultimately, at the end of the day, that 26.5%, if we bought a property at 170 back in 2012 and it is now worth 537,000 now, that 26% is way higher because of that principal pay down and because back then we were cash flowing really well back in 2012. So that would have obviously dramatically changed that number. And I'm going to guess it's probably like in the closing in on 100% type thing based on those numbers that you're seeing.
Yeah, I'm just going to add one more thing before Matt kind of jumps in here is to not only think about, let's say in the 5-year marker, we refinanced that property, withdrew some of the equity and bought another property with the amount that we had kind of gained in that. And then now we've got 2 properties, getting those, maybe similar rates of return. So all of a sudden we've kind of doubled up on our equity and our possible returns.
I'm so grateful to Rob Carrick for writing this article because it's led to some really terrific conversations, that we've had. And he concludes the article by saying, from his analysis, it's really a tie, real estate versus the stock market over the last 10 years. But I think what we've done here is do a much deeper dive to really uncover what our conclusion is that real estate is a clear winner. And guys, the whole mission of our podcast here is to demystify real estate investing, to educate others and provide some real tangibles and to really help others discover what we've already discovered about real estate investing. We want to share this because it's exciting, it's life-changing, and it's awesome. So I think today's episode really unpacked that and will have hopefully allowed others to have some further insights into real estate investing and to get excited as we are excited about real estate investing.
Thanks for that, Matt. And, if you've been listening to this and you've been convinced that the real estate market is the better choice, like we have articulated, we've tried to make the case here because we completely believe it. And you're still on your heels. You're still like, hey, I'm not sure. It's risky. I don't know how to manage all those, properties or a property. Then don't forget that's why we're here. We're here to not only provide education here on the podcast, but if you are looking for a partner to go into your first deal with, or maybe your second deal, and then take some of that pressure off, take some of that kind of worry off because you're partnering with folks who have gone through this, know what they're doing, and can do all the managing side for you, then consider JVing with us, joint venturing with us on our next deal. You can join our list. Head on over to investedteacher.com/JV. That's investedteacher.com/JV. Fill out our form, join our list, and next time we have a deal, we may consider, or we can partner with you and make sure that you started your investment journey.
Hey, I want to thank everybody for the ratings and reviews. Keep those coming. But on today's episode, I got kind of like an interesting request. If you found this to be intriguing, if you found that you learned something from this particular breakdown of a typical news article where, you know, it shared all factual information, but maybe just not at the depth that maybe you may have appreciated, what you could do is you can share this episode by heading to that link. If you head to investedteacher.com/episode 23, you're going to see the link to that article from the Globe and Mail. What would be amazing is if you hopped into the comments and then like pasted a link to this particular episode so that all the other people in the comments who are sort of like wondering, you know, like, is it really good? Is it, you know, and they're thinking about the primary residence, like all of that confusion that's going on in the comments, you can help bring this message to more people. That would be fantastic. And I know that there's a handful of you out there that are committed enough to do it. So thank you in advance.
Links, resources, and transcripts from this episode can be found over on the website. That's investedteacher.com/episode 23. Again, that is investedteacher.com/episode 23.
All right, invested students, that's it from us. Class dismissed.
Hey, my friends, this content is for informational purposes only, so do not construe any such information or other material as legal, tax, investment, financial, or other advice.